Hey everyone, welcome back. It's Greg. It is Wednesday, January 28th, 2026, and I am going to mix things up a little bit and just give you a report on what happened today. We're in the middle of earnings seasons, and it was a pretty big day. We had the Federal Reserve announcing their decision. We also had earnings from a couple of the very biggest tech players. So let me just give you a brief synopsis. Meta, formerly known as Facebook, gave their earnings, which were they beat on revenue, they also beat on earnings, and they raised their forecast for the year pretty significantly. And remember they do 97% of their revenue comes from ad sales. So selling advertising. That's always a reflection on the consumer, and it can be great. And obviously, that's putting a lot of eggs into that one basket. But they're doing well. They're selling a lot of ads, and it's always a reflection on the consumer and spending on the consumer. So very strong there. And they also raised their capital expenditure, what they are going to spend on building out AI and all of that. Everything goes into that. The talent, I can't believe the millions, tens of millions that they're spending on these AI engineers. But anyhow, they raised that significantly for the year to $135 billion for the year. So Meta's stock after the market was up pretty significantly. Last I checked, it was somewhere around 9%. But the market liked that, which is another tell for me, because we've seen in the past that sometimes the market is, they reward the spending on AI and sometimes they punish it. To me, this is one of the most significant things about today, because the market, at least initially, we'll see the next two days what happens, but it rewarded the extra spending that they're doing. So that's a significant turnaround from the last 4 months or so. And that also goes along with the rotation back into some of the bigger tech names. Right at the beginning of this year, for the last 3 weeks, we saw sort of an attempt to rotate into some of the smaller cap stocks, a lot of them unprofitable companies, which rely heavily on interest rates and borrowing. But just recently, just this week, we saw money go back into the tried and true. And we've been talking about this the last year, that it's running home. Every time there's rotation, the market, and they go running back to the tried and true, the big tech stocks that have amazing businesses, amazing cash flow. But this rewarding of an increase in CapEx, or capital expenditure, very significant. That tells me the sentiment um, of the AI trade right now. So important in my mind. Okay, so then also Microsoft reported they were down after their earnings, even though they beat on both revenue and earnings. But their cloud revenue, their Azure cloud revenue, was down just a little bit, and their margins, the profit margin that they make, was down just a teeny bit. And really, the market really, in my mind, I mean, they were down a couple of tenths of a percent, from 39.2 to 39.1 type of thing. And really not that big of a deal, but the stock was down pretty sharply on that news. In my mind, I felt like it was an overreaction to the downside. So we just talked about Meta going to the upside. This one was a little overdone on the downside to me, because so my read into that is that software stocks are continuing to get beaten down and questioned. So good news from Meta, the artificial intelligence play and spending on it is back in favor. Software stocks are continuing to get hit hard. And over the last 6 months, 8 months, 9 months, the software stocks have been really called into question. People are thinking that AI is going to be so amazing that they are going to AI, the large language models are just going to be able to write code and basically take over all of the, software, be a little dramatic, but take over, a lot of profits and functionality from the software businesses that are out there right now. Stocks like Adobe and ServiceNow, which we're going to get into next. But there's a thought out there that software is really going to be cannibalized by AI. And so those stocks, the software stocks, have really taken a hit over the last, you know, 6 months, 9 months or so. So I'll just skip around and, well, let me just quickly go over Tesla and then I'll go hit ServiceNow. And so Tesla reported, and as I'm not. I'm not a Tesla bull. I invest where there are fundamentals in addition to, a great balance sheet, a great business, a moat to competition. And Tesla was a car company. They are no longer a car company. Let's just say that. They are now operating completely off the promise of robotaxis and robots, Optimus robots, which neither one have been delivered. And if you want some good reading, go see how their driverless vehicles are doing in Austin, Texas. And they say that they've taken out the people that are overseeing the process, that sit in the cars as a safety companion. But again, we've talked about it. Tesla only has cameras that they operate on, and there are fundamental flaws if you don't have radar and lidar and all that kind of stuff. But hey, prove me wrong. But Tesla was, for the first year, the reason I would just want to touch on that, this is the first year that they've had a decline in revenue, first time ever in the company's history. And yet the stock was up the last I checked. And also Tesla is going to invest a couple of $1 billion into Elon Musk's own large language model, XAI. So they're spending money on XAI, and their their revenues have turned negative for the first time ever, and the stock is up. Go figure. On to ServiceNow. Excuse me, guys. This is the software aspect, sort of encapsulates that software sentimentality or sentiment that is really gotten hit, as we say, and is beaten down. And I haven't seen a change in that. Last I checked, their stock was down, almost a couple of percentage in during the market regular hours, and after they reported, even though the report was good, they were they did not. The stock was down pretty hard. Last I checked, excuse me, you guys. I'm just going to be real, keep it real, right? But no, they were down over 6% last I checked. And so they also beat on revenue, they beat on earnings, and they raised their guidance for the year. They reported that revenue, subscriptions, and remaining performance obligations, RPOs, were all up over 20%. RPOs were 25%. And over the last year, ServiceNow has purchased 3 different companies to incorporate it into their full stack of AI service offering. And those companies do things like they cover the Internet of Things, which are normally very vulnerable to cybersecurity threats. Your MRI machine, your router at home for sure, but your printer even. Things that the Internet of Things that are quite vulnerable. They're covering security on that. They're covering security on the application and management of their overall, uh, enterprise management software and artificial intelligence. Basically, they're integrating a lot of security into what they already have. ServiceNow is pretty amazing. They've got I'm a fan of it, and I'm keeping my eye on the stock, and I'll tell you that after I've seen it lately, I've really wanted to, I believe in the company, and I absolutely believe in the moat. And I've done some pretty deep research into what it would take for a chatbot to try and start to replicate all these things. And then I put myself into the seat of the CEO of a company that, would I spend the money for the product and the history and the of ServiceNow? Would I spend that premium versus, trying to develop something in-house or trusting my employees to run freely with different AI agents and all of that? So this is yet to be proven out, but I will tell you that I had my eye on it lately, and I did pick up a little bit of the stock. Again, as we've talked about, you never know, you never go all in, you know. Things have been down. The sector as software is very negatively viewed right now. The stock has been on, a real downward slide, along with a lot of other software like Salesforce and even Microsoft, but I just felt that with a sort of a cumulative extra 8% drop just today, that and based on the reports, and of course I listened to the earnings call. If you want to hear a great CEO, Bill McDermott from ServiceNow, go on to go and listen to that. It's pretty insightful, and please, I mean, it takes 30 minutes up to maybe 45 or an hour tops to listen to an earnings call. And if you're going to invest your money, that's, in my mind, the least that you can do. It gives you such great insight into the vision of the company, the performance, obviously, all of the numbers from the CFO, chief financial officer, that comes on, and also the management, the leadership, which how important I think that is. So I can't recommend that highly enough. I mean, take the time, think about how much money, let's say you put $1,000 onto a stock. It's 1 hour of your time tops. If I paid you $1,000 an hour to ensure your, decision investment, I think that's well worth the time. And I know there are a number of you that are putting up more than that. So anyhow, keeping an eye on ServiceNow. Look, these guys operate under the rule of 55 plus. That is 55% being the combination of their revenue growth and their profit margin. Those two combined have every single quarter have been at least 55% revenue growth and profit margin, which is fantastic. And I, as you know, as you've gathered in the past, and as I've said, I like looking the other way. When the whole herd is going that way and they are so negative on software, I'm looking over here to see, what? I'm not buying the hype completely, and I'm looking for the best of the best in breed. And so we'll see what happens with it. But again, obviously not advice. I don't do that, and you shouldn't rely on it. So that's my disclaimer for this show. And the last thing quickly was the Federal Reserve reported today. They had their 2-day meeting, and as expected, they held interest rates steady, didn't change. No big surprise there. They said that unemployment was, low, higher, low, fire, but it was steady. Inflation was a little bit high, but they don't see any great shock coming with that. No big surprises. And overall GDP growth for the U.S. economy looked pretty good, pretty solid. And so they didn't make any changes. And all I'm going to say about that is that we've spent a number of years over the last 4 years putting so much emphasis on the Federal Reserve, okay? Me, I am downplaying it for the year. Maybe they'll cut once, maybe they'll cut 0 times, maybe two. Who cares? It's not going to make a difference for your mortgage. And I'm sorry, but it's true. They control the short end of the curve, and the 10-year just is not going to move that much. And people have been making investments thinking that they were going to start a cutting campaign, which would be great for those small companies that borrow a lot, or just companies that borrow a lot in general, because there are some big tech companies that do that as well. I'm not counting on that. I'm counting on the Fed to be rather benign. We can talk later on about everything that goes into it with growth and inflation and surprises there. But remember, this year is, I'm staying cautious. I hope you are too. So that's the summary for today. I hope that helps you guys. And I hope you are having a good midweek. And I will see you soon. Take care. Thank you.